Hello, everyone, and welcome to the Buck Stops Here. I am Catherine Murray. Well, I'm pleased to have our next guest join us. Chad Morganlander is the Senior Portfolio Manager at Washington Crossing Advisors, an asset management company with $11 billion under management. Chad, great to be able to catch up with you again. It's been a very long time, but you and I did used to speak a lot over the past decades or so. So thanks for joining.
Well, thanks for having me on.
Thank you. Chad, why don't we first just get your top-down view and also how you approach money management? What's your style?
Well, our style is one where we focus primarily on quality investing, where we're buying companies that are consistently growing, consistently profitable, and they don't have a lot of leverage. And the reasoning for creating this style with our colleagues here at Washington Crossing is because we've experienced the 90s euphoria with the boom to bust and what the dramatic effects that had on not only institutional portfolios, but individual investors' wealth. So we wanted to be quite the opposite of that experience.
Hmm. And let's then bring it forward. It's interesting that you talk about the '90s. I was working on Wall Street in the '90s as well, and we really do remember the boom and the bust of the dot-com era. But there's a lot of money managers out there that don't go back to the '90s. And when we think about the AI investing theme, which I'm a huge fan of, people who've been in the business a long time do also have concerns about some of the financing, and is there too much exuberance? Where do you stand on AI and what I just mentioned?
So we are very, very optimistic about the technology, about the longer term ramifications to corporations in regard to productivity, in regard to profitability and whatnot. But this currently, at this point, you're in a capital investment cycle. And what that means, and the key word there is cycle, is that there's going to be a huge infrastructure build out, which you're experiencing now. Profitability and operating margins and profit margins go up dramatically. And then when this cycle starts to decelerate, that is the back end that is of a concern. And we believe that currently the market is mispricing
Hmm.
risk. And therein lies the big question mark and something that we should explore.
Let's talk a little bit about that. What exactly is the market mispricing when you say it's mispricing risk? How do you define that?
Well, you could over extrapolate as an investor future growth. You could over extrapolate future profitability and return on invested capital. But you could also look at certain market indicators as, let's just say, a carbon monoxide detector or a fire detector in your house. Look at credit spreads, high yield credit spreads to treasuries, the risk free rate here in the United States. At this point in time, it is as tight as it was back in 99 and as well back in 2006, 2007 before the housing crisis. So
Hmm.
that means to the investors that investors are more greedy and they're not taking into account any type of risk or recession or any uncertainty. And this is now at a historic tightening.
Yeah, that's really interesting because you hear that a lot in various reporting that the credit spreads are very tight, which to many people would suggest that there isn't a lot of risk, and that's why they're tight. But the other side, which you're pointing out, is it's not accurate.
Well, you're just not pricing in any type of, say, negative or decelerating issue. And what happens when credit spreads get to be in such a tight range is that it bids up not only equities and high yield, but it does that with also other various investments like private equity, private credit, and venture capital. And we all know what's happening today. It's more of a euphoric system, hence the reason why one needs to be somewhat more circumspect.
Very, very fair. With respect to AI, though, in trying to get it right, and we'll put this up on the other side of the break. But what are the themes that you're thinking about? Like, do you invest in chips? Where do you place some of your investments?
Yeah, we want to be invested in certain parts of the AI infrastructure. Look no further as a company like Cisco or IBM. they will catch a tailwind as the investment spending continues to accelerate. You want to be in some of the hyperscalers, but
Okay.
you just want to be mindful.
We'll take a quick break. We'll be right back. Chad, I just want to continue the AI discussion because it is just such a theme that I think people are still really learning about and trying to decipher. So, when you say you also invest in hyperscalers, how do you go about doing that?
Well, we actually would buy the individual securities of companies like Microsoft or Google or Amazon, of which, for full disclosure, we own in the fund as well as personally. And the reality we believe is that over the long run, they will be at least best suited for monetizing the return on their investment that they're making, but one still has to be somewhat concerned about the level of investment and the pricing of things like inference and compute, which still is a big question mark.
Big question mark as well in terms of whether or not this CapEx actually will turn into return on invested capital. And, that's number one. And number two, what are you actually paying for these stocks from a multiple perspective? Where do you stand on both of those items?
Well, it depends on which companies we're going to talk about. If you talk about the neo clouds, I think that those companies are perhaps farther out on the risk spectrum than we would consider here at Washington Crossing Advisors. They'll be more reliant on and more of a concern about price sensitivity of compute. So as you start to see data centers start to come online, there could be a real dislocation of pricing, which could then perhaps prevent them from being profitable. But when we look at the other companies, the bigger hyperscalers that have really better balance sheets, we're a little bit more comfortable gaining exposure there.
And Chad, did you go down the food chain at all in terms of taking a look at energy companies or utilities?
Yeah, we would be somewhat more, I think, hesitant to be investing in them. The leverage ratios we believe are going to get to be a bit higher than we would prefer as
Mhm.
they build out this infrastructure. You have to be somewhat more concerned about also some of the accounting they're using to
Mm.
justify their build out. It's really a concern of ours, Catherine, that the price of compute and the profitability of these large language models is really somewhat cloudy. And we can't really draw right now a clear line towards profitability. And when it comes to the large language models, they have to train their models to be on the frontier. And if they don't, it's kind of like old milk sitting in your refrigerator. Okay, it will go bad. So the price of tokens will actually go down. So this is still a big question mark, and we want to just be more conservative with how we're deploying our capital.
So it's interesting. So when you're talking about the price of tokens, the price to use these AI models goes down. It's difficult to find that cross in terms of the revenue if the price is going down for these large language models and the profitability, and we just don't know where that intersection is and on what time frame. Is that essentially what you're saying?
Well said. That's exactly it. And yet, investors are going all in on building out and throwing money at these models, and it may very well be a foolhardy venture. So you just
Mhm.
want to be somewhat more diversified. Yes, there are going to be seams of opportunity, but if you recall, back in the late '90s, the bulk of the money was made post .com dislocation. And therein lies our viewpoint that you may want to just not play the game as much and just sit back and wait until there is a dislocation.
Yeah, I understand that. It was a big fallout after the dot-com boom and bust. Real brief, and then we'll pick it up on the other side of the break. But the one of the other factors in the market right now is what the Fed may or may not do, and the changing of how the Fed is communicating with the street, Wall Street, that is. What's your quick view? And again, we'll pick it up.
Yeah, they right now have plenty of runway just to stand pat and not raise rates at this point. Um, our viewpoint is that they will wait until next year to actually make a move. They'll lay out their guidelines on what they will define as a hot inflation number, uh, and then go forward from there.
Hmm. So, with respect to the Fed, then no moves between now and year end.
No moves, and the inflation numbers that just came out justify that stance.
Okay, we'll take a quick break. We'll be right back. Chad, we were just mentioning that you do not expect the U.S. Federal Reserve to make any moves in terms of rate changes between now and year end. But talk to us a little bit more about how accommodating or not they are with
Well,
their balance
they
sheet.
Yeah, well, we're anticipating that after they have their various meetings, that they will lay out a plan regarding what economic numbers they'll be looking at to perhaps look at what inflation trends will be or the economy or employment. The balance sheet, as we know, uh, Warsh is going to try to lower the balance sheet. He really pushed back on QE2 back in 2010, and we believe that he will continue to whittle down that balance sheet. The only question mark that's out there is what happens when credit spreads that we mentioned, high yield spreads start to misbehave. The Federal Reserve, when that happened historically post great financial crisis, would come in and actually increase their balance sheet. That was their tool.
Yeah.
And if they're not using that tool and credit spreads blow out, what then will they do?
Right. I guess the question I should ask as well is what does this really mean though in terms of easy monetary policy and helping the economy? Where do you think worse stands?
Well, after listening to him a couple of times at his meetings, it seems like he wants to step away from being the conductor of financial conditions. He wants financial conditions to have their own type of ebb and flow, and the Federal Reserve not be as heavy-handed. So, yet he's saying all of this when credit spreads are 268 on the high yield. So we'll have to see on that front. And when it comes to rate policy, he will perhaps be gearing more towards being more hawkish, at least initially, overall.
So, Chad, if anybody's been following, the business news for the past couple of weeks and recognizing that, to your point, that Warsh, it seems, wants to have the market make its own moves, and then the U.S. Federal Reserve can come in and do what needs to be done. And I forget the last time that the Fed operated like this, was it in the 80s?
Yeah, it was. It was with Alan Greenspan, where everyone was had a big question mark on what he was going to do and what they were going to do, and they would look at his briefcase as he was walking into the meetings, and there, I think, he is the direction where he wants to go. It's actually, I think, a step in the right direction. They've been
That was going to be my
overcommitted.
next question. It's a step in the right direction.
Totally. Okay. Because right now, every governor has their own opinion, and there's complete confusion on what they do, and they try to over optimize the financial system, and that's where the balance sheet manipulation came in, and he rejected that. This, though, will perhaps crash into the political reality with the president in regard to being more dovish. I generally don't know if he will be that dove that the White House was hoping for.
Right. And so this is something we have to keep watching and be very mindful of. The other item we have to talk about, of course, is the conflict with Iran. I think that many people thought that this was going to be much more short lived. We've got the US midterms coming up. What are you expecting as you put money to work or invest other people's money?
Well, the shorter term resolution to this doesn't seem to be coming to fruition. So if you were to look at it from a longer term perspective, it doesn't seem like the other side, Iran, has a real incentive to cutting a deal. They can influence politics here, influence inflation trends by holding off making an agreement. So we will have to see from that perspective. That is another risk that we believe is being mispriced in the financial system. So one has to be somewhat more mindful about that political risk.
And is it mispriced because of the impact it could have on the midterms if the war keeps going? And or do you look at it more from an energy inflation perspective?
From both perspectives. And this is the inflation perspective that the Federal Reserve has no control of, unfortunately. So it's one of these questions about where that fits in to the financial system.
Okay, we'll take a quick break. We'll be right back. So, Chad, we've pointed out, you pointed out some areas of concern that we need to be mindful of in terms of really understanding what the risk in the market is. I do want to get quickly before we jump into your portfolios. What is your view, though, on the overall economy?
So U.S. economy is really strong. Capital investment is surging. Profitability is surging, due in part because of that massive capital wave that's going into AI. So earnings are going to be really resilient, and that's a real positive and a tailwind overall. And employment trends, they're going to kind of linger here. We don't think that the employment picture is dreadful. We think it's actually quite resilient.
Okay. So it's important to point that out because there are so many positives as it relates to the US economy, and yet there are these risk factors in terms of, what are we paying for and are we paying too much? So when you take a look at your portfolios, how are they constructed?
So we started Washington Crossing in 2003, 2002, and it was after the dot-com debacle. So what we decided we wanted to do was not chase benchmarks, not chase thematics, but construct portfolios in a way where the thematic is high quality companies with lower volatility. And if you put together a portfolio with a diversified portfolio of 30 to 40 names, that are of that high quality with very little debt, that are consistently growing, consistently profitable, that focus on rising dividends because of a rising income stream of I'm talking about the earnings coming in,
Right.
then they will be more resilient.
And so what kind of companies fit into that?
So you could look at many companies from the perspective of Microsoft to a company like Illinois Toolworks to Procter and Gamble or Merck, for example. And many of these companies they've been unloved, due in part because of this euphoria that's occurring in the high momentum arena. And
Yeah.
we believe overall that, this is a seam of opportunity because multiples have come down, but yet earnings growth has been quite
Mhm.
sustainable and quite resilient.
On average, are these companies tending to trade at a below market multiple?
Yes, many of them are. In particular, some of the companies that are looked upon as perhaps AI victims within this cycle, and we believe that those are the real tremendous opportunities that investors should perhaps consider.
What would those companies be? You're not referring to software companies, are you?
Well, I am
Or
in a
maybe.
way. Yes, I am. Like, for example, dare I say, a company like Accenture on the software side, on the consulting side, rather. We believe that companies across the globe, in order to implement AI, will have to use outside expertise, and they will hire people from Accenture. But even a company like ADP, which is a payroll service company, or Broadridge, those two companies are in the rising dividend portfolio, and their multiples have compressed because of the AI halo concern. And it's nonsensical. These are seams of opportunity that investors should perhaps consider.
Hmm. It's so interesting that you say those names because I personally haven't even looked at them because of what you're saying. We all kind of get caught up in this momentum trade, and these companies that they're so front and center every day. It's interesting to take a look at the ones from the past. I think I was working on Wall Street when we took Accenture public, if you can imagine that.
Yeah.
It's a long time ago. Let's take a look at your other portfolio as well, your Victory portfolio. And I should also mention too that people access this through their investment advisors. But what's the Victory portfolio?
So that portfolio is a go anywhere strategy, which is based again focused on high quality companies that are growing, profitable, and well capitalized. That portfolio has been around for well over 15 years, and it's more concentrated. It doesn't have a dividends overlay to it, but companies like Hershey's and Pepsi are in that portfolio alongside many of the tech names that are very popular today.
Do you have any concerns about the GLP-1 drugs impacting a Pepsi and a Hershey's?
That has been a concern in that the multiples have compressed. But now that what you're seeing is still a continuation of organic growth on the top line. So, they really don't have a lot of it built-in assumptions or over extrapolation built into the valuation.
Okay, Jen, we'll leave it there. Great to see you. Thank you.
Thank you.